All right, guys, give me a sec. Let me move this over here. Let me make sure everything's coming up. Let me go to this live feed. Awesome, awesome, awesome. All right, I see myself. Hang on a second. Let me first move this camera over here, and let me move this back up here so that way I can see myself. Hey, I just want to say thanks for joining me on this In the Know 5-Minute Fridays, 5-minute-ish Fridays. The goal is to every Friday at noon to touch on a particular topic with real estate, mortgage note, real estate investing, finding private money, just investment in general. So I am going to go ahead and move this over here, go back to the PowerPoint presentation, make sure that's coming up. And it is. Awesome. All right, hang on, give me a sec. Move this over here. All right, once again, I just want to say thank you for joining the In the Know 5-Minute-ish Fridays. In case you're new here, like I was initially saying, my goal is to every Friday at noon to touch on a particular topic, usually 5 minutes or more, depending on if there's any questions or how big the topic is. But in this topic, I'm going to cover how IRR can be manipulated, why smart investors dig deeper. IRR stands for the internal rate of return. I'll actually get into this here in a little bit. But before starting that, I am not a financial planner or a CPA. This video is for educational purposes only. Please always consult a qualified professional for advice. Please speak with your financial planner, CPA, or your attorney. That way they have your interests at heart. Take anything that I or anybody else gives you or goes over, please take that to somebody and let them help you do your due diligence on this. So with that, so what is IRR? It's actually the internal rate of return. It shows how fast your money grows. It's the rate at which the deals break even over paper, or I'm sorry, on paper. And it's common in real estate investing, real estate and note investing. And really, it looks good in a pitch, but can fool you if you're not actually careful. And I'll actually go over an example here. So the problem with IRR, it assumes you reinvest your profits at the same return immediately without any drag. So that means as soon as you get it, you instantly identify a deal and you're instantly investing in that deal. That rarely happens. So whether you're in the first year, second year, or third year, these examples that I'm going to show you, it's projected over a 3-year timeline, so I'll go over that here in a little bit. It can actually inflate performance in early payback deals, and it doesn't reflect actual dollars in your pocket. I mean, ultimately, that's what matters the most is the dollars back in your pocket. And like I was saying before, it's great for a pitch deck, but not always real life. So here's an example. This is just, I'm going to go over to a spreadsheet here in a little bit, but just say, for example, you have a $10,000 investment. Scenario A, you get a 20% IRR with early payoff. Scenario B is you get a 12% IRR with full term. But one's the 12% is really all actuality. It's more or less like annualized over the course of that time versus the 20%. That's why you have a higher rate than the 12%. But see, in scenario A, you need to reinvest at the same IRR rate at 20%, rest of the original loan. And from my experience, that's often harder than what it actually is in order to do that. So I am going to bring over my spreadsheet here. Give me a second. I'm going to see if that pops up here on the screen, and it is. Let me zoom in a little bit just so you guys can see. Oh, that's going to be too much. Okay, perfect. So that way I just zoomed in on it. So let's look at scenario 1, cash flow, versus scenario 2, end payout. So you can see that these IRRs, they're the exact same. 3 years investment, $100,000 each separate, but you get an IRR of 15%, right? And then if you break it down annually, if you look at the annualized ROI, this one's 9%, this one's 15%. So what's happening is you're getting cash infusion. Like each year, in this particular example, you have $50,000 coming in, 50,000 on the second year, 50,000 on the third year. So your net gain is 28,500, which gives you, like I said, a 15% return on your money. But what's being assumed with IRR is you're taking this $50,000 and you're reinvesting it immediately as soon as year one ends. As soon as you get that $50,000, you're taking that $50,000 and you're putting it back in the marketplace at 15%. And you're earning that 15% over the next 2 years. And then the second $50,000 that you get in year two, you're immediately putting that back in the market for the next year. And then the third year, you're not gonna have anything in the market. That's just gonna come to you. So let me expand this column here. Let me unhide this, and I'll show you this real quick. Unhide columns. And so just to prove my point with this IRR, so the $50,000 with compounding at 15% within 2 years, you should make $66,143. This one, a year from now, compounded at 15%, 57,508. The last year, that's just what you're going to get back. So your total projected profit is 152,000 minus the 100 gives you 52,000. Your cash on cash is 52.15%, and then your annualized rate of return is 15%, right? So you're over the course of the 3 years. So 15%, 15%, 100% matches up. But watch what happens if this payout comes at a different time. So assume you don't get anything in the first year, and assume you get $100,000 in the second year. The IRR drops down to 12%, right? So the point is these IRRs can be manipulated at any given time in order to promote a different scenario than what's really actually going on. So if I look at the scenario 2, the payout happens at the end of the third year. So nothing's coming in on the first year, nothing's coming in on the second year, but you get $152,000 on the third year. So you get a $52,000 gain. That gives you a 15% IRR, and annualized rate of return is 15%. So this one kind of it closely matches the annualized rate of return, because in all intents and purposes, you are getting your money back in the third year, right? So that's why you're able to capture the same IRR as 15%, and the annualized rate of return is also 15%. But if you notice these two scenarios, you have cash flow and payout. The IRRs are the exact same, 15%, 15%. But your gain is 52,000, and your gain on this one is only 28,500. Now, obviously, right, you get different gains, but they're promoting they're promoting the same IRRs. But that's where you need to do a little bit due diligence by not just assuming that this IRR is gospel. You need to ask key questions on what's the cash payout. How is this distributed yearly? Look at past performances that somebody's pitching you. That way you can see that are they truly earning a 15% on their money? Because I'm telling you from experience, it is very difficult to take this $50,000 and invest this. Now you can. I'm not saying that you can't do it, but I've just done it a handful of times with these. So at the end of this $50,000, at the end of year one, you're going to have to take this $50,000, and you're going to have something already lined up that's earning 15% or greater. So that's what they talk about, this drag, this lead time. It's good on paper, but it always doesn't necessarily happen. And that's what I'm trying to drive home this point, is these IRRs can be manipulated depending on when your cash is coming in, or if it's at the end of the life cycle of the projected project, right? So just always do your due diligence on this. Don't take somebody's word for it. Always double check, triple check, and run the numbers yourself. Because if you don't reinvest well, your return actually drops faster than what you actually thought it would be. And like I was showing you, how's it manipulated? Front load returns to boost the IRR. Big early payments make the IRR looks great, even if the total return isn't. It cuts the horizon time short to make the IRR pop. I've 100% seen this in a lot of deals that I've looked at. Ending the deal early compresses the time, inflating the return on paper. Omitting service costs or delays. I see this happening a lot too. Skipping real expenses make the deal seem more profitable than what it actually is. And then also, they hide reinvestment assumptions. These IRRs assumes you're reinvesting at the same high rate, which rarely happens. And so what to actually look for instead, look at the total gain over the actual cash in hand. Compare it to an annualized ROI for apples to apples comparison, and always ask, can I reinvest that early cash at the same return? Some of the key takeaways that you should be asking: always ask for full cash flow breakdown. Don't invest based on IRR alone, and the deal with the best timing, not just the best math, wins. And lastly, IRR is just a best case scenario. Unless you're a robot with perfect timing and endless deal flow, your real return will be lower. So just always, please, always do your due diligence on this, and just don't take this at gospel. If somebody's preaching a high IRR, always ask for past deals that they've done. Look at the breakdowns, look at the cash flow payouts, because once again, these are just projections. So, and ultimately, what matters is the cash that you actually get, your investment, and cash that you get back, and how long it took you to get that money back, right? So, if you're not investing those profits that, like I was showing you before with those scenarios, like scenario one at $50,000, if you're not investing that $50,000 at that 15% or greater IRR rate for the next 2 years out of that 3 years, your IRR drops dramatically. And that's why it's always, 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 always important to ask those questions, and then always run your own numbers. And if you don't understand this, please speak with a CPA or a financial planner, or if you want, just book a time with me. Actually, you can just send me an email, larry@lghinvestments.com, or you can give me a call, 513-301-1468, or schedule a 30-minute call with me, talkwithlarryhoffman.com, and I will be 100% more than happy to sit down with you and show you this in more details, because people act like this IRR is gospel, and it 100% isn't. And you need to use other tools and metrics to look at this, and once again, just not take that as gospel. So if you have any questions, please feel free to ask them. And if not, please feel free to book a time with me or shoot me an email. I've got a lot of emails from you guys asking different questions. So I've got different things planned in the future to address some of those questions. So, all right, guys, I don't see anything. And let me go back to this camera. I don't see anything, and let me move this back over here. And once again, if you have any questions, hang on, let me pop this up. Book a time with me, talkwithlarryhoffman.com. And like I said, I would be more than 100% happy to go over these numbers, or even that spreadsheet. I can even go into additional deals that I've done